Welcome to today's video on maximizing retirement wealth for high-income 1099 contractors. First, we will set the stage by comparing the solo 401k and the SEP IRA and explain why one is clearly superior for aggressive savers. Then, we will cover the Backdoor Roth IRA strategy, the Pro-Rata rule, and compliance steps you must not miss. By the end, you will know exactly how to combine a solo 401k with a Backdoor Roth to turbocharge your tax-advantaged savings. Here is the agenda. First, the big idea. Next, the solo 401k advantage versus the SEP IRA. Then, Backdoor Roth essentials. After that, the Pro-Rata rule warning. Next, the compliance must-dos. Then, we will outline an action plan. Finally, we will test your understanding with a short quiz. The big idea is straightforward. If you are a high-income 1099 contractor trying to contribute $30,000 to $40,000 or more each year, the solo 401k usually wins. It gives you both employee deferrals and employer profit sharing, resulting in higher limits than a SEP IRA. Moreover, it avoids the Backdoor Roth IRA complications that a SEP IRA can create. Let us break down why the solo 401k tends to outperform the SEP IRA for high earners. First, in 2024, a solo 401k allows an employee's salary deferral up to $23,000 or $30,500 if age 50 or older, plus an employer profit-sharing contribution of about 20% of net self-employment income, all subject to a $69,000 overall cap, or $76,500 with catch-up. Next, a SEP IRA only allows an employer contribution. For sole proprietors, this is typically about 20% of net earnings, and for S-Corp W-2 wages, it is up to 25%, but still capped at $69,000. Without the employee deferral, many contractors cannot reach $30,000 to $40,000 in contributions unless their income is very high. Furthermore, for Backdoor Roth users, a solo 401k does not create IRA balances, so it avoids the Pro-Rata rule. In contrast, a SEP IRA is considered an IRA and will be included in the Pro-Rata calculation, potentially causing unexpected taxes. Finally, the solo 401k gives better control because the employee deferral helps you front-load savings even when profits fluctuate. In contrast, the solo 401k includes both employee deferrals and employer profit sharing, which makes reaching contribution targets easier, and it does not interfere with Backdoor Roth strategies. Meanwhile, the SEP IRA is simpler but allows only employer contributions, which can limit total savings unless income is very high and can trigger the Pro-Rata rule that complicates a Backdoor Roth. However, the solo 401k includes more administrative responsibilities, including filing Form 5500EZ once plan assets exceed $250,000. This table summarizes 2024 limits. The solo 401k offers an employee deferral up to $23,000 or $30,500 if age 50 or older, plus an employer contribution of roughly 20% of net self-employment income, up to $69,000 total, or $76,500 with catch-up. The SEP IRA has no employee deferral and only allows the employer contribution, typically about 20% of net income, with the same dollar cap. Importantly, the solo 401k is compatible with the Backdoor Roth strategy, whereas a SEP IRA counts toward the Pro-Rata rule and is not friendly for that purpose. Now let us clarify the Pro-Rata rule. In a Backdoor Roth, you contribute after-tax dollars to a traditional IRA and then promptly convert to a Roth IRA. However, on December 31st, the IRS aggregates all of your IRA balances, including traditional, SEP, and simple IRAs. If any pre-tax IRA balances exist, your conversion is proportionally taxable, which defeats the purpose. To avoid this, you should either keep your IRA balances at zero by rolling any pre-tax IRA or SEP IRA into a solo 401k before year-end, or skip the Backdoor Roth that year if you cannot clean up the balances in time. Here is a practical sequence. First, open a solo 401k with a reputable, low-cost provider. Next, make sure to elect your employee deferrals by December 31st, and remember that you can fund them by your tax filing deadline, including extensions. Then, calculate your employer profit-sharing contribution, which is typically about 20% of net self-employment income, and fund it by the tax filing deadline. After that, execute the Backdoor Roth by making a non-deductible traditional IRA contribution and immediately converting to a Roth IRA, documenting it on Form 8606. Meanwhile, eliminate any pre-tax IRA balances by rolling them into your solo 401k before December 31st to avoid the pro-rata rule. Additionally, monitor plan assets and file Form 5500EZ once assets reach or exceed $250,000. Finally, review your plan annually with a qualified tax professional. This timeline illustrates the annual sequence. First, throughout the year you earn income. By December 31st, you must elect solo 401k employee deferrals. By the tax filing deadline, including extensions, you can fund both employee deferrals and employer contributions. Simultaneously, by December 31st, confirm that you have zero pre-tax IRA balances if you intend to use the Backdoor Roth. Then, by the April filing deadline or with your return, file Form 8606 for the Backdoor Roth. Finally, by July 31st, file Form 5500EZ if the prior year's solo 401k assets were $250,000 or more. Here are calculation pointers. First, for sole proprietors, the employer profit-sharing contribution is roughly 20% of net earnings after subtracting 1/2 of self-employment tax. Next, for S corporations, the employer contribution is up to 25% of W-2 wages. And employee deferrals must also come from W-2 wages. In all cases, the overall Section 415C limit applies $69,000 or $76,500, with catch-up for those 50 or older. Finally, you should document your elections and calculations and maintain payroll and self-employment tax records to support your numbers. Quiz time. Which account type avoids the IRA pro-rata rule when executing a Backdoor Roth IRA? Option A, SEP IRA. Option B, Traditional IRA. Option C, Solo 401k. Option D, Rollover IRA. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, Solo 401k. Solo 401k balances are not included in the IRA aggregation used for the pro-rata rule. By contrast, SEP, Simple, and Traditional IRAs are included. Second question. At what plan asset value does a solo 401k require filing Form 5500EZ? Option A, $50,000. Option B, $100,000. Option C, $250,000. Option D, $500,000. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, $250,000. When plan assets reach or exceed $250,000 at year-end, you must file Form 5500EZ by July 31st. Here are the key takeaways. First, a solo 401k typically beats a SEP IRA for savings targets in the $30,000 to $40,000 range because it combines employee deferrals with employer profit sharing. Second, pairing a solo 401k with the Backdoor Roth is a powerful approach that avoids pro-rata complications. Third, keep your IRA balances at zero by year-end or roll them into your solo 401k to preserve the Backdoor Roth benefits. Finally, remember to file Form 5500EZ once plan assets reach $250,000. To reinforce the process, here is a concise Markdown checklist and a couple of formula notes you can copy into your planning notebook. First, elect solo 401k deferrals by December 31st. Next, fund employee and employer contributions by your tax deadline, including extensions. Then, confirm zero pre-tax IRA balances on December 31st. After that, execute the Backdoor Roth and file Form 8606. Finally, track plan assets and file Form 5500EZ if they are at least $250,000. The included formulas remind you how employer contributions are typically calculated and the overall cap for 2024. Before we conclude, here is an important disclaimer. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Your situation is unique, so consult a qualified professional to ensure the calculations, elections, and forms are handled correctly for your circumstances. To summarize, select a solo 401k to reach higher contribution levels and maintain compatibility with the Backdoor Roth strategy. Next, avoid the Pro-Rata rule by eliminating pre-tax IRA balances before year-end. Finally, track your deadlines. Elect deferrals by December 31st, fund contributions by your tax filing deadline, and submit Form 5500EZ by July 31st if applicable. Before we sign off, if this video clarified the solo 401k versus SEP IRA decision and helped you plan your Backdoor Roth strategy, please like the video, share it with another contractor who needs it, and subscribe for more tax-smart wealth strategies. In the comments, tell us your biggest solo 401k or Backdoor Roth question and what topics you want next.